welcome to VC Circle podcast. I'm your host, Joseph Rai. In this episode, we will be in conversation with Sanjay Swamy, who was a founding member of the so-called missed call marketing platform ZipDial, which was acquired by Twitter in 2015. Sanjay is currently managing partner at early stage venture capital firm Prime Venture Partners, which has raised 3 funds so far. It's currently investing out of its third fund of $60 million. Prime Venture Partners has invested in startups such as fintech firm NiYo, invoice discounting platform Edtech, healthtech firm MFine, security management startup MyGate, consumer lending platform MoneyTap, and Edtech startup Sunstone. Hi Sanjay, welcome to our podcast and thank you for joining us.
Thanks, Joseph. It's great to be on the show. And just a quick clarification, Fund 3 that we are investing out of is actually 72 million. But yeah, it's great to be on the show and very exciting time in India. Obviously a lot has happened this year and happy to share our experiences.
Cool. Did you top up the third fund? Because when it was announced, it was $60 million.
Yes, it was 60 was the first close. And then we had a little more interest. So we took in a couple more partners and it's at 72 million.
Cool. Okay, so let me begin by asking you as to how Prime Venture Partners has been engaging with its portfolio companies during the pandemic.
Yeah, so I think there's several aspects that we engaged with over the course of the last 4 months with our portfolio. To start with, I think we were one of the first to realize that this is probably going to be quite a serious impact in terms of the working patterns and the safety requirements and so on. So I think very early, probably in the first week of March itself, we had called an emergency meeting with all our portfolio founders and had them exchange best practices and notes. And, we realized that a few of the companies were actually ahead of the curve and a few others were quite oblivious to what was likely to happen. But it helped a lot because suddenly everybody took this very seriously. And so when the lockdowns and things like that came, actually already all the companies were very well prepared from a working style perspective, right? So that was the first aspect. And then I think all the companies had prepared their teams to work from home, VPN access, internet connectivity were required. All of these things were, put in place very early across the portfolio. And I'm glad we did that in hindsight, obviously, because it would have been a serious impact if not. That being said, the second part was to quickly look at, if we are looking at a June 2021 type of a horizon, are all the companies, financially in a good place to get to that point? And what do they need to do? Thankfully, several of our later stage companies like MyGate, NiYo, Edtech, MoneyTap, MFine, a lot of them had raised fairly substantial rounds less than 12 months ago. So at least there was no concern about their, viability, right? And ability to survive. A few of the younger companies we looked at, clearly might need to raise it between now and that time frame. And so we, but they're younger companies and we have enough reserves for those. So I think they're fine. So broadly, I think we came quickly, we're very thankful that we don't have a lot of high burn companies in our portfolio by choice. And, all our companies will make it through, at least from a financial viability perspective, through this, this hump. But that was an important thing to analyze. And we had each of the CEOs and the founding teams analyze what the impact was going to be for them, and broadly what we found is there were 3 categories. There was a very small group of companies that were, substantially going to be impacted, probably a couple of them, and one of whom was planning a pivot anyway, so that didn't really hurt them. The majority of the companies felt this is anywhere from a 3 to 9 month business impact, but the core business was not going to be the core business was going to come back, and as it has turned out, that recovery has happened, thankfully, a little sooner than they had anticipated. About, I would say, a few companies said there won't be any impact, and that's how it played out. About a third of the companies actually saw a huge tailwind And as you can guess, these were companies that are companies like MyGate or companies like MFine in the healthcare space, or companies like Quizzes and Sunstone in the education space, right? And this is true probably across all VC funds, but we certainly saw some of that. And so for these companies, I would say the world has moved forward. Although the circumstances of COVID are obviously very tragic, the world has moved forward by anywhere from 3 to 5 years.
Okay.
And so a lot of the effort there went on trying to really work with the founders to make sure that they were able to capitalize on the opportunity and do whatever changes they needed to do to gear up for a faster growth, right? So that was, I would say, the first 60 days of COVID, right? Getting everybody ready, assessing the things, getting them to replan, and so on, and then finally being, ready to move forward, right? But subsequently, we sort of looked at the opportunities that were arising, right? And we'll talk about that. But portfolio-wise, those were the three things that we did.
Okay, cool. So, much has also been talked about layoffs at startups and even big businesses during the pandemic. What did Prime Venture Partners tell its portfolio firms on how to deal with layoffs specifically?
Yes, so certainly, I think these are unusual times, right? So where the companies were well capitalized, I think they took a very sensitive approach, and really, unless a role was completely going to be eliminated in the new world, right, where there was a delay, but the people were, really good quality people, they figured out several ways, there were combination of strategies across the portfolio where, there were reductions, it's a lot of cases, the founders took, massive reduction in their compensation, nobody got bonuses in some cases, and tried their best to protect the people, right? Because that was sort of seen as a very important thing. And so I would say over the first 60 days, there were probably no layoffs, or maybe one company probably did that, which was already planned, right? Then I would say over a period of time, things have come back. So certainly new hiring has been much more cautious, right? But overall, broadly, very few layoffs in the portfolio. Obviously, our advice to the founders was, whatever you're doing, do it once and swiftly, and and if not, don't do anything, right? I mean, moving forward, you can't keep doing these things multiple times, because then the existing people are also insecure. So whatever had to be done in one or two cases was done swiftly and as empathetically as possible. So a little more generous perhaps on the severance and things like that in the few cases where people had to be cut. But I would say, broadly, there were probably a couple of companies where there was impact. Otherwise, in all cases, most roles were maintained. In some cases, as I said, some bonuses were not given out, or in one company's case, I think they looked at the furlough for a few weeks, where they wanted to retain people in the long run.
Okay. So we know that Prime Venture Partners has a measured approach towards its investment, does not write checks aggressively. But Prime Venture Partners has been rather quiet on the investment front this year. Is this a conscious decision that you've taken? Or have you done some deals which we don't know about?
Actually, quite the contrary, right? I mean, yes, so our nominal pace is, 3 to 5 new investments a year. And generally, our model, just to back up, is, we are a early stage investor. We're typically the first institutional check. We typically will invest in 3 to 5 new investments a year. Our focus areas are financial services / fintech, SaaS, and all themes around digitization of India, right? And that's, I think, what SaaS is the one sort of global thing that we do, but everything else is focused on digitization of India, whether it's healthcare, education, logistics, and so on. I think what we may end up with unusually, I wouldn't have bet on this in March, is this may end up being probably the most active year in our history in terms of new deals that we are working on and investing in. And largely because a few interesting things have happened. One is, I think we're seeing very laser focused entrepreneurs now, right? So one of the good things that have come is, and I was listening somewhere else today as well, whenever there is confusion, there is immediate clarity, right? In terms of what are your priorities and what aren't the priorities, right? So I think when you're, it's like a child in the candy store, and when there is so much variety, you're always struggling with what to do. And as entrepreneurs, you see opportunity everywhere. But the moment you know that you're going to have finite resources and money is going to become dearer and you have to choose, right? Suddenly it becomes very clear that the only thing I want was this particular chocolate, right? So I think in the same case, the same thing is happening here. So we're seeing very high quality startups and entrepreneurs at the seed stage, right?
Okay.
So we have been very active. The other thing is we're also seeing a lot of businesses that are just getting a massive tailwind because of COVID, right? Because the big theme that we have focused on always has been digitization. And that is, of course, the mantra at all levels, right? Even large public companies, right? So, globally, right? So as a result, we're pretty excited about the quality of companies we're seeing. Obviously, we still take a very measured approach, and, doing deals on Zoom is not something that we were trained to do, and we've had to learn, and we're refining the process and so on. But I would say at a minimum, it will be as active a year as any other year for us.
Okay.
And we're actively looking for founders to talk to us.
When you're saying that you're going to be active as any other, more active than the other years, will it be more than 5 deals, 3 to 5 deals that you've done so far?
It'll certainly be in that range. It might be 6. I don't know, because the rest is still, half a year to go or 5 months to go.
Okay.
But yeah, it will be, quite an active year for us. It already has been.
Cool. So what new themes do you see emerging in the COVID-19 and a post-COVID-19 world?
So I think there are several things that are happening here which make it very exciting, right? The first theme is, of course, the customers have now realized that remote is now, so to speak, and there's a slight fun in that because it was always something that they considered was in the future, but now it's all here and now, right? So anything that has to do with digitizing things that that we're going to solve the distance problem. Suddenly now it has to happen. It's a priority because you cannot do business, right? It's a question of survival. And so everybody has to go about looking at all their business processes and saying, we need to fix these, right? And that's what is going to drive a lot of efficiencies in the business, which is the good news. It's just that people were always very, I would say, the incumbency of existing business processes and the inertia around that was delaying this decision. Now you cannot delay that anymore, right? So everybody is looking at this. So we have, for example, one company that used to sell, early stage company that sells to very small customers in the remote parts of India, rural India. And so in the past, they had to say, the original plan was we will look at 3 states, focus, on that, get to some critical mass, then raise the Series A and then go to other parts of the country after we've proven it out. All of a sudden, the customers are now all accessible on, video conference calls. And so they're able to now, in fact, they're getting inbounds and they're closing business in remote parts of India, which they had not initially thought would be in the first place. Right? So as a result, what's happening is 3 things. One is, the customers are getting more focused on digitization, which creates great opportunity for startups. Customers are accessible now all the time. In the past, meeting a customer, if you're selling to a large bank in Mumbai and so on, it was very hard to actually get everybody in the room together. It's actually a lot easier now, right? And the customers also are quite comfortable meeting the solution providers over a video conference call, right? So the good news is good companies will now be able to accelerate, right? The bad news is that your competition also has the same differentiator, right? So, I mean, this is no longer a differentiator, your product and your service needs to be the differentiator. The other thing is global opportunities have opened up, right? So that's the third thing we're seeing, that a company in Palo Alto has no advantage when selling to a customer in San Francisco as a company in HSR Layout or Koramangala, right? So Indian startups now, as long as they're building the best of class product and service for the market, can rapidly start expanding internationally, right? That wasn't the case in the past. Once again, there was a sense of sequentiality, prove it here, then go there. Now that's no longer required, right? Visa boundaries, all of these have gone out the door. So in that sense, it's a very exciting time because the market is beckoning us. The geographic boundaries have gone away. And young startups, and the best products have a much better chance of succeeding today than in the past. So we're very excited about this.
Okay. So one of the themes that drew a lot of VC money during the pandemic was the Edtech space, right?
Yes.
So how do you read this huge interest in the Edtech space, and do you see this sustaining once, hopefully, things get back to normal?
Yeah. So as always, and my good friend Shailendra at Sequoia has a great statement. Things are never as good as they look. Things are never as bad as they look, right? So the new normal will be slightly off of where we are right now is the general expectation. But the new normal is substantially higher than where we were at the start, right? So has this been a permanent transformation? I would say very high likelihood for these industries, EdTech and health, right? But will it be the only way in the future? No, right? Right now, we have gone completely from in classroom or in hospital to completely telemedicine or distance learning. Right. The future will be some hybrid of the two, right? And then hopefully a good hybrid of the two. But the percentage of telemedicine or distance learning will be substantially higher than it was at the start, right?
Okay.
So that is what we're going to see, and as a result, right? Clearly, there is a like I said, it's a 3 to 5 year advancement of these industries, right? Globally, right? And companies that were already in the sector, that had already done some of the hard work and were bracing themselves for a 2022 to a 2025 type of a explosive growth opportunity, and we're doing a lot of the hard work. They've all had to grow, 3 years in 3 months, right? And those that have the capacity to do it, should see huge outcomes, and that's why it's very exciting for venture capitalists, right? Because we'd love to see to partake in these upsides. Hence, they have seen a lot of funding. I suspect this will continue for some more time because I think it's very clear now that we're not going back to the old ways anytime soon, right? I mean, it's going to be a slow rollout. I'm sorry, there's a helicopter right above me. It's going to be a slow rollout and recovery, relatively speaking. And I think people also see the merits of these new approaches, right? So as a result, yes, there will be some more investments happening, I think, in the sector for some more time.
Okay. So there's been a lot of talks about consolidation happening in the startup space also because of the pandemic and the huge money Reliance Jio Platforms has raised. Do you see mergers and acquisitions happening at a rapid pace? And do you expect your portfolio companies also to be part of this exercise and hence you also getting an exit sooner?
Yeah. I think the short answer is that is bound to happen because there will be some sectors that have been like if you were in the travel as a startup sector, or if you were in retail, perhaps, offline retail, those sort of areas, it's likely that, those markets might take a little longer to come back. And so companies that are not, most startups are typically capitalized for 18 months, right? And could stretch it to 24 months if they have some good revenues. So somewhere along the way, there will be companies at all stages of those cycles that will perhaps run out of money. So in those cases, there will be some opportunities for consolidation because there will be some bigger companies that will pick up some high quality assets at reasonable prices, right? So that's one. The second aspect will be as the larger companies see some of the younger companies having explosive growth, right? So the first one is where you're selling a company that's not likely to make it. The more exciting one is where you're buying a company that's having explosive growth, right? So that's what we all look for, right? As VCs also, or as entrepreneurs, we're looking for companies to be bought. We're not looking to sell our companies, right? If at all. And those are the exciting ones. And I think there are, large players looking at what's happening now in India. And if people feel that the opportunities are sooner rather than later, yes, you will see some of that happening. I wouldn't call that consolidation. I would call that a attack strategy, right, by someone.
Okay.
As a VC, as Prime, we take a very long-term view, and all of our investors also have, guided us to take a very long-term view. Yes, there will be some exits that will come, but that's not fundamentally what's driving us. We might see something opportunistic and do it, but our desire here and the approach we have at Prime of having a fewer number of companies per fund, for example, like Fund 2, almost a $45 million fund has, 9 companies in it, right? Which is very unusual. Normally it would be closer to 20, 25.
Right.
So our philosophy has always been we want to build some long-lasting, iconic companies in their verticals. So that's our default approach, and we want to back our entrepreneurs for the longest time. But every now and then, if an opportunity arises and it's the right thing for the founders, we will support them.
All right. Okay, cool. Thank you, Sanjay, for sharing your thoughts with us. And that's all we have in this edition of VC Circle podcast. Thanks for listening. Goodbye and take care.
Thank you. And I just want to add a closing thought to entrepreneurs. There's never been a better time. Now is as good a time as any. Follow your dreams, chase your dreams. It's a great time to get started right now.